Hey there, smart traders and students of the financial markets. Welcome to a key and practical course here on our YouTube channel, where we don't just look at charts, we think like professionals. In this series, we'll dive deep into one of the most critical aspects of trading, position management. You'll learn how to handle your trades after you enter, using structured, logical techniques. From the simple set and forget approach to partial exits, break-even strategies, and trailing stops, we'll cover them all with real examples. These skills will help you reduce stress, protect your profits, and make smarter, more confident decisions at every step. If you're serious about growing your account and mastering risk, this course is exactly what you need. Let's get into it.
What is position management? Position management refers to all the decisions a trader makes after entering a trade, up until the moment that trade is closed. Contrary to popular belief, a good entry is only part of the success. What truly separates a profitable trade from a major loss is how well the position is managed while the price is moving. In position management, the trader decides at what point to close the trade, in profit or loss, whether and how to move the stop loss, if partial profits should be taken at specific levels, and how to react logically to market volatility. The main goal is to minimize risk, protect profits, and avoid emotional decisions. With solid management, a trader can stay in control even when the market doesn't go as expected.
Why is position management so important? A great entry means nothing if you can't manage the trade after. So many traders spend hours analyzing the perfect setup, only to lose money because they had no plan for what comes next. Price rarely moves in a straight line. There are pullbacks, fake-outs, spikes, news events. If you don't have a plan for how to react, your emotions will take over. You'll close too early, hold too long, or move your stop loss based on fear, not strategy. Position management helps you stay calm and focused during the trade. It allows you to protect profits, reduce losses, and make consistent decisions. This is where amateurs get shaken out and where professionals shine. It's essential.
When does position management actually start? Most traders think position management begins after a trade goes into profit. But the truth is, it starts the moment you click buy or sell. From the second you're in a position, you should already know where your stop loss is, how much you're risking, what your target is, and how you'll react if the market goes against you. If you're figuring it out as the trade unfolds, you're not managing the position, you're reacting to it. And that's where most traders get emotional and make poor decisions. Real position management is proactive, not reactive. It's built into your plan before you enter. So the next time you take a trade, ask yourself, do I have a plan for what happens next? If not, you're gambling, and the market eats gamblers for breakfast.
So, how do you actually manage a position? Finally the good stuff, right? Everyone loves to talk about trade entries, but when it comes to managing a position, let's fix that. There are a few simple proven ways to manage your trade after entry. Let's break them down. 1, set and forget. You place your stop, your target, and you walk away. No emotions, sounds easy until you start checking the chart every 10 seconds. 2, partial exits. You take some profits at certain levels. Great for locking in gains, but tricky if you exit too soon. We've all done that. 3, break even move. Once you're in profit, move your stop to entry. Smart risk control, but watch out for fake outs that knock you out early. Yep, annoying. 4, trailing stop. Move your stop with the trend as price moves in your favor. High potential, but it takes discipline and nerves. No method is perfect. That's the truth. Oof.
Greetings to all dear traders. A question that was asked in the group was about making a trade risk-free, which in itself is a type of position management method. This means that when we open our position, we can manage it in various ways until it reaches its goal. I have now specified the things that are considered as position management methods. The first method, or as Forex friends call it, set it and forget it, sell and let go, means that you take a position and then you don't do anything else with it. The stop loss and take profit are clear. Only two things can happen. Either our trade stop loss is hit or the price reaches its target. This is a simple and straightforward method that serves as a starting point for many traders. The second method is the Marshall partial method, which here refers to partial exit, which will be explained in detail later. Also, break even or risk-free, and trailing stop are other important methods that I will explain schematically for each of them. Let's assume that we have marked a demand zone in this part of the chart and a supply zone in the upper part. We can consider that these zones belong to our 20-minute time frame. In the middle of these zones, we might also have a 5-minute supply zone. Our price has been in an uptrend and has now reached this area. Now we assume that the trend becomes bullish. When our price reaches our demand zone in the 1-minute time frame, after the breakout that occurs and the structural change that happens, we prepare for entry. This is an introduction to how to enter a trade and manage it, and it will help you identify potential opportunities.
Sorry. Okay, we are now assuming that this is what happened in our demand zone and in the 1-minute time frame. Now a demand zone has formed for us in this area. We are going to enter a long position on this demand zone. So we are now assuming that we have entered our long position and our price is now going to move upwards. Now, let's specify these points. Let's say that in this price area, this will be our entry price. So here our entry point is in this area. Now we specify that, assume this is our stop loss line. We mark this in red. This is our stop loss. This precise definition of entry and exit points is crucial as it forms the foundation of your risk management and allows you to effectively control your exposure.
So important.
It helps in setting clear boundaries for your trade before it even begins, providing a structured approach.
And now, let's specify this with the correct terminology. We also mark a line in this area, change its color, and consider this as our target. So, now we have opened a position with a stop loss here, with an entry point here, and we have placed the target up there. If we want to represent this as a position, we assume that such an event has occurred, and we have considered such a target, for example, target 5 for it. So, now we have entered a position with target 5. If we want to draw this 1-minute time frame in a slightly different way to make it clearer, let's assume this is our 1-minute time frame, and these are the shapes that have formed. This meticulous planning process ensures that you have considered all aspects before entering a trade and have a clear roadmap for managing your position effectively throughout its duration.
So we discussed the first method, which is the set and forget approach. This means that once we activate our position in this area, we wait for either the price to reach its target or for our stop loss to be triggered. This first scenario can be very favorable. However, sometimes you see that the price makes a lot of plays along this path.
For example, if you consider the price moving up and then coming down to hit the low, it might even return close to our entry price and then fluctuate again before finally reaching its target. So in the set and forget mode, we no longer pay attention to the internal movements of the price because we have determined that our position must either be stopped out or reach its take profit. This method is suitable for those who prefer not to constantly analyze small market fluctuations and instead focus on the ultimate outcomes of their trades.
So this is the first method. In the partial exit/sleep exit method, we can observe the price behavior as it moves in this manner, considering the 5-minute and 1-minute zones we specified. Alternatively, we can assume a percentage-based take profit. This means, for instance, if our price reaches our TP2, a percentage of the position exits, and it can continue to move upwards in the same way. Now, to illustrate this with an example, suppose here we set our TP, for instance, TP2. We then mark this, indicating that this is our TP2. We might also mark another line, perhaps our TP4 or TP3, any level we can consider. For instance, I'll set TP4, and the top one is our main target, TP5.
So for clarity, let's assume this is our TP5. In the partial exit mode, let me clear these extra markings. You see, partial exit can be done in two ways. We can say that in TP2, when our price reaches our TP2, for example, we exit 40% of the trade volume, and when it reaches TP4, we exit another 40%, leaving the remaining 20% to reach its ultimate target. So this is also a type of position management, either based on numerical TP levels or based on specific price zones. Suppose there's a price zone in our way, perhaps a 5-minute zone or the main 1-minute zone. We can set our first TP there. This means, for example, we exit 40% of the trade at our first TP, which is this zone. This strategy helps you gradually secure your profits while maintaining the potential for further growth, effectively balancing risk and reward throughout the trade's progression. It's like piece by piece. For the second 40%, for example, suppose there was another zone higher up, we exit there, and then we take our third TP to our main target. So this covers the discussion of partial exit. Now let's clear these extra markings so I can talk about break even. You see, break even also works in two ways. You can either use a target size, meaning, for instance, when the price reaches its TP2 or even its TP1, in whatever way you prefer, that's up to you. You can make the price break even or risk-free. This means that after, for example, if we consider this to be your TP2, if we want to say this is our TP2, we say that when our price makes this price movement, after the position reaches our TP2, we no longer reduce the volume. Instead, we just move our stop loss to our entry point. This approach gives you peace of mind that in the worst case scenario, your initial capital is preserved and you will not incur any losses.
If we entered the trade with our original full volume, the price can then fluctuate in any way and reach its target. Alternatively, if it doesn't do that, the price might fluctuate and then hit our risk-free stop loss, in which case, at the very least, we haven't incurred any losses. It just means our risk-free stop was triggered. You can consider one model in this way. The next model that I usually use for making trades risk-free is this. Suppose we open this trade when my price comes and breaks its last 1-minute high, meaning the last 1-minute high it formed, upwards. I move my stop loss and set it to risk-free. This strategy allows you to manage your positions with the least possible risk while ensuring you don't miss out on potential profit opportunities. It is highly suitable for conservative traders who prioritize capital preservation above all else, offering a secure approach to market engagement. Ooh, that's a clever trick.
Now, if my price reverses and tries to hit my stop loss, I exit the position at zero profit, meaning I haven't incurred any loss. And if it wants to go towards its target, then I am, so to speak, risk-free. There's no problem. When I am risk-free, if I get a continuation position in the middle, I can comfortably enter again. Why? Because my first position, which has been made risk-free, is not a loss for me. If I decide to take this new position as well, at most, only the 0.5% loss that I have set for myself will occur. This flexibility allows the trader to pursue new opportunities in the market without concern for previous positions, as the primary capital is already secured from risk, providing a psychological advantage and more aggressive trading potential.
Because this position has been made risk-free, it's as if this position doesn't even exist. I've re-entered a trade on this position. Let's assume again that if this is our entry point and this is our stop loss point, and our target is, let's say, our original zone again. Now, if my price comes and breaks its last high again, I will make this position risk-free again. This means the price moves to my purchase price, maybe a few points higher due to spread or commission we pay. And so this position of mine is also risk-free, and we have no problem. And now the next mode that can be used. Let me clear these extra markings again so we can talk about it. The next mode is the trailing stop mode. In this mode, suppose after the price goes up, you can move your stop loss swing by swing with your price. This method allows you to dynamically preserve your profits while remaining safe from sudden price reversals.
For example, let's consider the set and forget method. When we manage this position in real time, its drawback is that if the price reverses and hits our stop loss, we exit the trade with a loss. Its advantage, however, is that if it hits our target, we reach the target with the full volume we had. For instance, if we risked 0.5%, as in the example we just gave, with a reward of 5, we can potentially add at least 2.5% to our account. In the partial exit model, its advantages are that we save a portion of the profit. Therefore, we are more comfortable psychologically. We can be at ease knowing that at the very least we have secured this profit. It's about defining your parameters up front and trusting the market to play out within those boundaries, reducing the need for continuous monitoring once the trade is active.
Now, if after taking partial profit, we also remember to go risk-free, then we are completely at ease. We have secured a volume of profit and also become risk-free. So we can do both of them together. For example, if we want to exit a portion of our volume at a reward of 2, we know we've taken some profit. If the price reverses, our risk-free stop will be triggered. Or if it reverses because, for example, we've taken 40% of our volume, even if it comes to hit our stop loss, it will either hit 0 or at least we'll have some profit, or it will be with a smaller stop loss. This gives us a lot of peace of mind knowing that we protected a significant portion of our gains while still allowing for potential upside. instance, let's assume if we were supposed to incur a $10 stop loss when we exit 40% at a reward of 2, now if our price wants to reverse and hit our risk-free stop, suppose we probably had $5 profit where we exited 40% at a reward of 2. We made $4 or $5 profit. We also reduced some of our volume. Now if our price wants to hit our stop loss, if that stop loss was, for example, $10, firstly, because we reduced the volume, it's now, for example, $6 or $5. So we had made $5 profit, and now it's, for example, 0. This illustrates how partial profit taking can mitigate potential losses even if the trade eventually reverses.
So a disadvantage of this can also be that when you are gradually taking some profit stage by stage, your volume effectively decreases until you reach the main target. For instance, if with that first example of 3 pages, we mentioned 2.5% in this example, this hypothetical position we considered was supposed to grow our account by 2.5% with partial exits. It would probably be, for example, 1.5% or something like 1.30 or 0.04%. This happens if it reaches the end of the target because we reduce the volume stage by stage. In the case of break even, I think I'd mentioned break even to one of the dear friends in the channel before, specifically this model I just described after the first swing. See, you need to expect this. You must be mentally prepared that the price will likely come back and hit your break even point multiple times.
This means it will hit your risk tolerance, taking you out of the position. Now, whether it gives you another entry or not is another matter. Its advantage is that one of our goals in the market is first and foremost to preserve capital and then to grow capital. Risk-taking makes us much stronger in preserving our capital. If we don't make a profit, at least we haven't incurred a loss. But consider that multiple times you enter a trade, the price goes up a bit, hits your risk-free point, and then moves again. You can re-enter the position a second time if your price is still in the zone and suppose gives you another position. It's possible it will hit your risk-free point again and move on, so many times.
So you must consider that for making trades risk-free, you need to be completely psychologically prepared for it so that if such an event occurs, you don't feel any discomfort or worry. The market always and always offers various opportunities, and just preserving your capital is enough. If you get 3 or 4 profitable trades in a week, your account will grow. This consistent focus on capital preservation, even if it means frequent break-even exits, builds long-term sustainability. It's truly about mastering your mindset to stay disciplined and avoid emotional trading decisions, allowing you to patiently wait for the next profitable setup.
And as for the trailing stop issue, honestly, I don't like it at all. I don't work with it. Why? Because swing by swing, when, for example, we assume the price is moving up from here in a minute, the price forms 2 swings. And we are also supposed to follow swing by swing, and it comes and hits the swing. The same issue happens and it goes up again and reaches its target, and it very quickly takes us out of the position and the price has reached its maximum. This method can be frustrating because you often see the market continue its move after you've been taken out, potentially missing out on significant gains. It simply doesn't align with my personal trading style and risk appetite.
So these are the position management methods. And as I've always said many times, you must have a personal plan and a personal strategy for these very reasons. You should specify in your strategy whether you want to work with a quote set and forget approach, or if you want to work risk-free, or if you want to take partial exits or use trailing stops, or perhaps a combination of these. Having a clear, well-defined plan is paramount because it removes guesswork and emotional decisions from your trading. It's your personal rule book for navigating the market.
Position management refers to a set of actions that traders take to control and guide their open trades until they reach their ultimate goal. This includes making decisions about entry and exit times and how to react to price movements. One of the simplest and most basic methods is the set and forget approach. In this method, after opening a position, the stop loss and take profit are predetermined and the trader no longer interferes. Only one of two outcomes is possible. Either the trade's stop loss is triggered and the position closes with a loss, or the price reaches its target and the trade closes with full profit. The main disadvantage of this method is that if the price reverses, you will definitely exit with a loss. However, its advantage is earning full profit if the target is reached. In this scenario, intermediate market fluctuations are irrelevant and the trader does not react to internal price movements.
The second method is partial exit, which allows the trader to exit a portion of their position volume at specified price levels. This can be done based on a percentage of the TP, for example, 40% at TP2 and another 40% at TP4, with the remainder moving towards the main target. Partial exits can also be executed based on important supply and demand zones. The advantage of this method is securing a portion of the profit along the way and reducing the trader's psychological stress. However, its drawback is that with each partial exit, the position's volume and consequently the potential final profit if the target is fully reached decreases. This means the overall profit might be less than in the set and forget scenario.
Break-even, or risk-free, is a key method in position management. In this method, after the price reaches a specific target, e.g. TP2, the stop loss is moved from its initial point to the entry point. This ensures that if the price reverses, the trade closes without loss, and at least the initial capital will be preserved. Another model for making trades risk-free often used is when the price breaks its last 1-minute high. The stop loss is moved to the entry point. The main advantage of break-even is capital preservation and the ability to re-enter a position if the market offers another opportunity, as the previous position has become risk-free. However, one must be psychologically prepared for the possibility that the price might hit the break-even point multiple times and take you out of the position.
Trailing stop is a method where the stop loss is dynamically and progressively moved swing by swing along with the favorable price movement. This allows the trader to lock in a portion of the profit while giving the position a chance for further growth. However, one of its disadvantages is that sometimes the price continues its movement after hitting the trailing stop and the trader misses out on a significant portion of potential profit. Ultimately, the most important aspect for any trader is having a personal trading plan and strategy. This plan should specify which position management method or a combination of them, such as partial exit and break even, will be used under different market conditions, e.g., during news releases or in calm trends. Backtesting and adhering to this fixed plan are key to long-term success in position management and account growth.
All right, let's dive into the topic that fries everyone's brain: Multi-Timeframe Analysis. I know. Everywhere you look, they show you this neat textbook picture where there's one big move with smaller, perfect moves inside it, and everything works like clockwork. It looks great, right? Super interesting. But then you go into the live market, and you see the market is playing a completely different tune, and all this weird stuff starts happening that nobody ever talks about. We're not here to tell you a textbook fairy tale. We're going to jump right into the thick of it and see what's really going on inside these 4-hour legs. We want to figure out what to look for in those moments when everyone gets confused and says, "What just happened?" So if you're tired of the dry, boring theory, you've come to the right place. Let's get to it.
Okay. Now for the main event. What's the difference between trend and order flow? You thought they were the same thing this whole time, didn't you? Yeah, most people do, and that's exactly where they miss huge opportunities, or even worse, jump into the wrong trades. We have a golden rule here. The trend, our main direction, belongs only to the 4-hour time frame. That's it. It's this red line you see that tells us the big picture story. Are we bullish or bearish? But order flow, that's a different beast. Order flow is a short-term stream of orders that can even go against the main trend. For example, our 4-hour trend might be bullish, but the price breaks a minor low on that same time frame, and suddenly our order flow turns bearish. Understanding this tiny difference is the key to knowing when you should only be looking for long positions and when you have permission to trade both sides of the market.
Are you ready to have your mind blown? We're about to get into the fractal view. This is the grand finale. Look, so far we've said we have a 4-hour time frame for the trend, a 15-minute for the order flow, and a 1-minute for our entry. Now we're adding one more member to this family, the 1-hour time frame. Why? Because there's a magical relationship between the 4-hour, 1-hour, and 15-minute charts. When all three of them are aligned, for instance, all three are bullish, whoa, that means our demand zones are incredibly strong and long positions will hit their targets like it's nothing. Now imagine the 4-hour and 1-hour are bullish, but our 15-minute turns bearish. What does that mean? It means we can take a small short on a 15-minute supply zone, but we have to keep in mind that the 1-hour demand zone will likely stop the price and turn it back around. This is what it means to understand market depth. This is how you play with probabilities like a pro.
And finally, the internal range, the place where the price starts playing ridiculous games. Look, we have one big 4-hour leg, right? A clear high and a clear low. Between that high and low, the price can do whatever the heck it wants. It can change its trend 100 times on the 10-minute chart. Go up, go down, break structures, get stuck in a range, anything. So where's the problem? A trader sees every break of structure on the lower time frame and thinks, okay, the trend has changed, when in reality, we're still stuck inside that same 4-hour leg. Here's the most important takeaway. Until the price hits a significant higher time frame zone, like a daily or 4-hour level, and then shows a change of character, we don't consider the order flow to have truly shifted. Understanding this means you won't fall for the market's traps anymore. You have to practice this stuff 100 times.
All right, let's get into one of those fundamental topics that can completely change your trading game, multi-timeframe analysis.
I know you've probably seen a ton of courses and they all show you this very neat textbook picture where everything works like clockwork. It looks great, doesn't it? But when you get to a real chart, especially in the live market, you realize the story is completely different. The market is full of weird, unpredictable moves that don't seem to have any logic, and that's exactly where most traders get confused and lose money. We're not here today to tell a textbook fairy tale. We're here to learn a completely practical point of view.
Our goal is to zoom in on those strange market events, the very moves that fall outside the textbook view and make you say, what just happened here? Our approach to multi-timeframe analysis might be a bit different from what you've seen in popular smart money courses. We don't want to just memorize dry formulas. We want to learn how to think like a professional trader and adapt ourselves to live market conditions. This session is all about reviewing structure from a multi-timeframe perspective and seeing how we can use different timeframes to our advantage to gain a real edge in the market.
So the topics we're going to discuss today on July 11th, 2025 are four main subjects. First, we'll review the multi-timeframe structure using our own practical method. Then we'll move on to one of the most important distinctions you need to know, the difference between trend and order flow. After that, we'll talk about the fractal perspective, which is a very special and powerful way of looking at the market. And finally, we'll open up the discussion on internal range within the multi-timeframe structure. To avoid confusion, we'll assign different colors to our timeframes. For example, a higher timeframe like the 4-hour will be red, a mid timeframe like 20-minute will be black, and an entry time frame like 1 minute will be blue.
Let's first revisit that bookish theory to understand where its weakness lies. Imagine we have a large upward leg on the 4-hour time frame, the red line. What does the theory say? It says that inside this 4-hour leg, we have another clean upward trend on, for example, the 15-minute time frame, the black lines. Then, inside each of those 15-minute legs, there's another smaller upward trend on the 1-minute time frame, the blue lines. In theory, this looks great and very attractive, and the trader thinks this is exactly what's going to happen. But the truth is, this view is overly simplified and causes a lot of problems in the real market.
The main problem is that many don't clearly and completely explain the events that occur outside of this theoretical model. That's why I feel it's necessary to discuss them in detail. Our perspective is fundamentally the same, but with the key difference that we also pay attention to those unexpected events and have a plan for them. So let's clear these diagrams and move on to the viewpoint we actually use. Before anything else, we need to separate two concepts that are the foundation of our work: trend and order flow. These two are different, and if you don't know the difference, you've already gone halfway down the wrong path.
All right, let's establish this rule for ourselves right now. For us, the trend is defined only on the 4-hour time frame. This means we never refer to a 30-minute move as a trend. When we in our group or in analyses say the trend, we are only referring to the move we see on the large 4-hour time frame. Now, let's assume we are in a 4-hour uptrend, meaning the price is making higher highs and higher lows. We don't care about the small, minor moves in the middle of these legs. The big picture is what's important to us. So, rule number 1. The word trend is only used for the 4-hour time frame and shows us our overall direction.
So if the trend is our overall direction, what is order flow? This is where it gets interesting. Order flow is the more short-term stream of orders, and it tells us whether buyers or sellers are currently in control. We identify a shift in order flow in 2 ways. The first method, imagine we're in a 4-hour bullish leg. If the price breaks one of its own internal minor lows, meaning an internal change of character happens, from that moment on, we say our order flow is turned bearish, even if our main trend is still bullish. This is the first model where we say order flow has changed and it signals the market is preparing for a correction.
The second method for detecting a change in order flow is a bit more advanced and is related to our lower time frame, e.g. 15-minute. Imagine we are in an uptrend and the price is moving upwards on the 15-minute chart. If this upward move reaches a significant supply zone from a higher time frame, like a 4-hour or daily zone, and after hitting that zone, it proceeds to break its last major low on the 15-minute chart, we also say the order flow has changed and turned bearish. So, this second scenario is dependent on hitting a significant barrier on a higher time frame.
Now, why are we emphasizing the difference between trend and order flow so much? Because our entire strategy is built on this foundation. Here's the most important part. When the trend and order flow are both moving in the same direction, e.g. trend is bullish and order flow is also bullish, we are only permitted to take long positions, buys. Under no circumstances do we look for sells in this situation because we would be moving against the main power of the market, and that means high risk. This is the simplest and safest state for trading, and we are always looking for these kinds of opportunities.
But when the trend and order flow are not aligned, for example, our 4-hour trend is bullish, but the order flow has turned bearish, the game changes. In this state, we are allowed to trade both sides of the market. This means we can look for short positions in supply zones and wait for opportunities for long positions in demand zones. These concepts might have some complexity at first, but I will try to cover all their parts. If you encounter specific cases during your practice, be sure to share them so we can discuss them together.
All right, let's go over a very, very important scenario that happens every day in the market and confuses a lot of people. Imagine we're in an uptrend and the price is moving up nicely on the 10-minute time frame, but suddenly it comes down and breaks a small low. The question that arises here and occupies everyone's mind is, has our order flow now turned bearish and should we be looking for sells? And my firm and resounding answer to you is no, absolutely not. This is one of the biggest market traps that inexperienced traders fall into. In this situation, we do not consider our order flow to have changed at all.
Now the question is why? Why, even though a low has been broken, do we not consider it a change in direction? The answer lies in a concept called internal range. When we have a large leg, for example on the 4-hour chart, the price can make thousands of chaotic movements between the high and low of that leg. It can go up, down, break minor structures. All these movements, as long as the price is not exited that main high and low, are known as internal range movements. That break of a low we saw on the 10-minute chart was merely noise and a movement within this internal range, not a real signal for an overall change in direction.
So if that break isn't a real signal, what is? When can we confidently say, okay, the order flow has actually changed? Our rule is this: we absolutely must see the price first hit an important zone on a higher time frame, like a 4-hour or even a daily supplier demand zone. After it has reacted to that zone, if it then comes down and breaks its last low on the lower time frame, e.g. 15-minute, only then do we say, okay, now our order flow has changed. This combination of hitting a higher time frame zone and then breaking structure on a lower time frame is the key to our method.
Now, what is the purpose of all this precision and obsession with defining trend in order flow? The ultimate goal is to know exactly where we are in the market and what we are supposed to trade. Should we only be looking for long positions? Should we be searching for short positions? Or are the conditions such that we can trade both sides of the market? This deep understanding of structure gives us a clear bias for our daily trades. On July 11th, 2025, and saves us from confusion and random trading. This is the main difference between a professional trader and an amateur.
All right, now that we've clarified the difference between trend and order flow and the concept of internal range, we want to add another incredibly powerful layer to our analysis: the fractal view. This perspective might be slightly different from common smart money courses, but I strongly believe in it and have gotten excellent results from it. In this view, we use 3 specific time frames that have a distinct relationship with each other: the 4-hour, the 1-hour, and the 15-minute or 10-minute time frames. These weren't chosen randomly. There's a mathematical sequence and harmony between them that helps us better gauge the strength of a trend.
What is the magical relationship between these time frames? There is a sequence with a factor of approximately 4 between them. This means that roughly 4 15-minute candles form one 1-hour candle, and 4 1-hour candles make up one 4-hour candle. This implies that these 3 time frames are like 3 gears of different sizes that are perfectly engaged with each other. The movement of one directly affects the others. This fractal view allows us to understand whether the power across all layers of the market, large, medium, and small, is aligned or not. This alignment is a very powerful signal for us.
Now, how do we use this fractal view? The best and strongest possible condition is when all 3 of our fractal time frames are aligned in the same direction. Imagine we are in a 4-hour uptrend, our 1-hour time frame is also bullish, and our 15-minute time frame is bullish as well. When this happens, what does it mean? It means the buyer's power is dominant across all layers. In these conditions, demand zones act very powerfully, and long positions have a very, very high success rate. This is the best case scenario a trader could ever wish for.
But the market isn't always this simple. The more complex situation is when these time frames are not in sync. Let's assume our 4-hour and 1-hour time frames are still bullish, but the price on our 15-minute time frame turns bearish. Does this mean the entire uptrend is over? No, it's just a warning signal. This situation allows us to look for short-term short positions on supply zones within the 15-minute time frame. But there's a crucial point we must not forget, and that is the power of our higher time frames.
When we take a short position on the 15-minute time frame in that unaligned scenario, what must we be aware of? We need to know that because our 1 hour time frame is still bullish, there is likely a strong 1 hour demand zone in the path of the price that could halt the decline and push the price back up. Therefore, we no longer expect the price to necessarily drop all the way to a 4 hour demand zone. This fractal view gives us a roadmap and tells us where the potential obstacles in front of the price are and where we should consider exiting our trade.
Now let's take the scenario even deeper. Imagine our 4 hour time frame is bullish, but our 1 hour time frame also turns bearish. What does this signify? When the 1 hour time frame also changes its direction, we can expect that our 4 hour time frame is about to experience a deeper correction. In this state, the price has the potential to continue its decline down to the main and extreme 4 hour demand zones. So, this fractal view helps us not only predict the direction, but also the potential strength and depth of corrective moves, preparing us for any scenario.
All right, let's get back to the exciting topic of the fractal view. In the previous part, we said that if the 4 hour and 1 hour time frames are bullish, but the 15-minute turns bearish, we expect a short-term correction. Now, imagine the correction gets deeper and even our 1 hour time frame turns bearish. What should we expect then? In such conditions, we can anticipate that the price will undergo a deeper, more serious correction on the 4 hour time frame. This means the price has the potential to continue its decline until it reaches the main 4 hour demand zones or even the 1 hour extreme zones. This layered analysis shows us the true depth of the market.
So that wraps up our discussion on the fractal view. But wait, there's one more very, very important issue that I completely forgot to include in my notes. Sometimes you get so engrossed in talking that you miss a few things. That issue is the concept of extreme and decisional zones. You'll hear these two names a lot in analyses. And if you don't know their meaning, you might get completely confused. Defining exactly what we call an extreme zone and which zone is decisional is one of the most basic concepts in identifying supply and demand zones, which we're about to break down completely.
Let's start with the extreme zone. What is it? In a bullish leg, the lowest demand zone that initiated the entire major primary move is our extreme zone. In other words, it's the origin of that move. It's that very first zone that caused the price to launch and create a new leg. The same logic applies to a downtrend. The highest supply zone from which the entire bearish move began is our extreme zone. This zone is the most important and powerful area in an entire leg because the whole structure depends on it.
Now that we know what the extreme is, what are the decisional zones? Apart from that one extreme zone, all other valid supplier demand zones that are formed along the path and within that leg are our decisional zones. Why do we call them decision-making zones? Because it's as if the price on its path reached these areas, took a short break, and then decided to continue its main trend. These zones are like rest stops on a highway. They have power, but their strength is never as great as the extreme zone, which was the origin of the entire move.
So now we have a power hierarchy for our zones. The extreme zone is like the king and commander-in-chief of that entire leg, and the decisional zones are like the soldiers and officers under its command. Knowing this difference is very important. When we are analyzing a chart and use terms like extreme zone or decisional zone, you need to know exactly which part of the chart we're referring to. This helps us understand which zones have more potential to reverse the price and which ones we should rely on more heavily.
Where is the strategic importance in all this? It's in defining a trend change. There's an incredibly important rule. Until our extreme zone is taken out, we do not have a change of trend. The price can come down and break through 3, 4, or 5 of our decisional zones one after another. Many traders panic here, thinking the trend is over and everything is reversing. But as long as the price has not reached our main extreme zone and taken it out, our trend remains fully intact. Let's visualize this. The price in an uptrend begins to fall. It reaches the first decisional demand zone, gives a small reaction, and breaks it. It moves to the next one and breaks that one too. It might not even react to some of them at all. But finally it reaches that extreme zone at the beginning of the leg. If it hits that zone and starts a strong move upwards from there, we are still in an uptrend and there is no problem.
Okay, this video is getting long and these have been heavy topics. I would have loved to show you all of these things on the chart itself to make it perfectly clear, but unfortunately there isn't enough time. I promise that in the next session we will do exactly that. You can consider this session as the schematic and theoretical foundation to get familiar with the principles, and in the next session, released on July 11th, 2025, we will go to a real chart and find these extreme and decisional concepts point by point. This makes the learning process much more effective.
And now for my final words to you all. The most important thing I ask of you is to practice, practice, and practice again. Especially this topic of multi-timeframe analysis and structure mapping. I've covered the general principles in this video, but I can never explain every possible market scenario because the market presents a new shape and a new event every day. The rest is up to you to see these things in the live market or in backtesting. If you can analyze it yourself, that's excellent. If you get stuck somewhere, be sure to ask in the group so your issue can be resolved.
Don't forget this. The most important technical topic we will ever grapple with is this very concept of structure. If we can't identify the structure correctly, if we can't diagnose the trend and order flow properly, then naturally the supply and demand zones we choose will be wrong, and consequently our entries will be wrong. So everything comes back to this. Please practice this until you are completely fluent, and then we can confidently move on to the next topics, like defining zones precisely and getting entry confirmations.
May you always be profitable and successful.
Our entire discussion was based on moving away from a simplistic, bookish view of multi-timeframe analysis toward a practical approach. Our main rule is that the trend is defined only on the 4-hour time frame and sets our overall direction. In contrast, order flow is the short-term market current. Its change is identified either by an internal structure break within the 4-hour leg or after the price hits a significant higher time frame zone and then breaks structure on a lower time frame. We call price movements within a confirmed higher time frame high and low the internal range, and know that structure breaks within this area are not necessarily order flow changes and can be traps. Finally, we distinguish between supply and demand zones. The extreme zone, which is the origin of the entire move, and decisional zones, which are waypoints. The ultimate rule is that a trend only changes when its extreme zone is broken, not the decisional ones.
Our trading strategy stems directly from this analysis. When trend and order flow are aligned, for example, both bullish, we are only permitted to take long positions. But when they are not aligned, we can cautiously trade both sides of the market. For confirmation and deeper understanding, we use the fractal view with the 4-hour, 1-hour, and 15-minute timeframes. The alignment of these three timeframes is a very powerful signal for high probability trades. If a lower time frame like 15-minute moves against the higher ones, it signals a limited correction, with the next higher time frame's zone, for example 1 hour, acting as the main barrier. In the end, the most important takeaway is that structure is the foundation of all analysis, and because the market is constantly changing, continuous practice is absolutely essential to master these concepts.
All right, let's get into one of those incredibly fascinating and key lessons that will take your analysis to a whole new level. So far, we've learned how to identify market structure, find supply and demand zones, and understand the difference between trend and order flow. But here's the main question. Why do some of our 4-hour zones hold beautifully and reverse the price, while others get sliced through like cheese as the price powers through them? Is there a way for us to better gauge the strength of a zone before entering a trade? The answer is a firm, resounding yes. And it's done through a deep understanding of fractal sequence and confirmation. This concept is the secret language between timeframes.
To grasp this concept more easily, let's use a business management analogy that makes perfect sense. Imagine the 4-hour time frame as the CEO of our trading company. The CEO is responsible for setting the grand, long-term strategies and the overall vision. The 1-hour time frame acts as our departmental manager. This manager's job is to take the CEO's broad strategies and translate them into more concrete, actionable plans. Finally, the 15-minute time frame is our dedicated employee, the one on the ground who is responsible for the practical implementation of those plans. Now, for a major project, our successful trade, to be executed flawlessly, what is the one essential requirement? It's that the CEO, the manager, and the employee are all perfectly aligned and in complete agreement. This harmony, this three-way consensus, is precisely what we call a fractal sequence. Think of it as a firm, confident
handshake between all levels of our timeframes.
Now, let's get more specific and technical. What exactly do we mean by fractal sequence? At its core, a sequence is about tracking the flow of power from the top down. We want to see if the strength and direction evident on the 4-hour time frame, our CEO, are being smoothly and fluently transferred down to the 1-hour time frame, our manager, and subsequently down to the 15-minute time frame, our employee. Or is there some conflict, some friction or disagreement among these layers of management along the way? The moment this flow of power cascades from top to bottom without any issues and all 3 time frames are pointing in the same direction, for instance, all are clearly bullish, we can declare that we have a clean, valid fractal sequence. In this state, the market is in its most predictable, healthiest, and most opportune condition for us to engage with.
Okay, great. We've identified a beautiful, harmonious fractal sequence. What do we do now? This is the exact moment fractal confirmation enters the picture, playing the role of our ultimate non-negotiable filter. We are past the stage of blindly setting a limit order on a 4-hour demand zone and hoping for the best. Absolutely not. Instead, we first patiently wait for the price to arrive at our zone. Then, acting like a professional detective, we drill down to the lower time frames, 1 hour and 15 minutes, and we wait for them to give us the green light, a signal that they too are bullish. This means we are waiting for our employee and manager to verbally confirm their positive outlook on the CEO's grand plan. This act of seeking confirmation from the lower time frames is our fractal confirmation, a step that dramatically and measurably reduces the risk of any given trade.
Perhaps the greatest strength of using fractal confirmation isn't just in finding good trades, but in preventing you from entering the bad ones. This distinction is absolutely critical for long-term survival. How many times have you found a perfect 4-hour zone where everything looked ideal, only to enter with hesitation and watch the price blow right through it, stopping you out? Fractal confirmation is designed specifically to prevent that painful scenario. In that exact situation, if you had waited for fractal confirmation, you would have noticed that your 15-minute time frame never gave you the required bullish signal. As a result, you would have never entered that trade in the first place, preserving your capital for a higher probability setup. This system methodically builds the discipline and patience required for professional trading.
So in this new lesson that we are beginning together today, July 11th, 2025, what exactly are we going to learn? We will meticulously go step by step through the precise rules for identifying a valid, quote, fractal sequence. We will use numerous real chart examples to learn how to patiently wait for, quote, fractal confirmation and get our entry signal from the lower time frames. We will also review the different types of confirmations that exist and learn which ones are best suited for various market conditions. By the end of this lesson, you will possess a remarkably powerful filtering system that will not only help you find better trades, but more importantly, will give you the confidence and the rules to stay away from bad, high-risk, and emotionally driven trading decisions.
Why fractals? The foundation of our theory. Before we dive into the rules and trade setups, I want to take a moment to explain the foundation of this fractal theory that I emphasize so much. The word fractal might sound intimidating or complex, but its concept is surprisingly simple and beautiful. In nature, fractals are self-similar patterns. What does that mean? It means a small shape or pattern repeats itself over and over to create a larger structure with the exact same form. Think of a snowflake, a tree, or even a coastline. They are all built from the repetition of simple, small patterns. Our core hypothesis is that the market also has a fractal structure, and timeframes act just like these self-similar patterns. This means the 1-minute time frame repeats itself to create the 5-minute time frame, and so on up the scale. This perspective gives us an orderly framework for understanding the market's apparent chaos and provides a basis for expecting consistency in its behavior.
The golden sequence of time frames. Now that we agree on the concept of the market being fractal, the next logical question is, if the patterns are self-similar, then there must be a regular and stable relationship between them, right? This is precisely why, after extensive research and testing, I arrived at a specific sequence of time frames that is perhaps being used in this manner for the first time in the smart money space. The 4-hour, 1-hour, and 15-minute sequence. Why these three specifically? Because they are the only time frames that have a nearly constant multiplier of 4 between them. 4 15-minute candles create one 1-hour candle, and 4 1-hour candles create one 4-hour candle. This gives us a perfectly equal and harmonic sequence, just like a pure fractal pattern in nature. Other time frame pairings don't have this clean relationship. For example, the multiplier between the daily and 4-hour charts is 6.
All right, let's turn this theory into a practical example. Imagine we are in a very strong bullish leg on the 4-hour time frame, which we'll represent with the color black. The price is making higher highs and higher lows, and everything looks perfect. A trader with a standard view would expect the price to react to one of the demand zones formed on this 4-hour time frame and continue its uptrend. This analysis isn't wrong, but it's very basic. As professional traders, we aren't satisfied with this surface level view. We want to put the market under a microscope, so we decide to zoom in on the last part of this 4-hour leg to see what exactly is happening on our lower time frame, the 1-hour, which we'll show in blue. This is where the real story begins.
We've zoomed in on the 1-hour time frame and are observing the internal movements of that large 4-hour leg. In an ideal world, the 1-hour time frame should also display a clean, bullish trend that is in harmony with the 4-hour time frame. But let's imagine that doesn't happen. Let's imagine that on the 1-hour time frame, the price comes down and breaks its last valid low, signaling a change of trend from bullish to bearish right on the 1-hour chart. This moment is one of absolute confusion for most traders. Our main higher time frame 4-hour is screaming buy, but our intermediate time frame 1-hour is now saying sell. This contradiction and lack of harmony between the fractal layers is an incredibly important signal that we must not simply ignore. This is where the difference between a professional analyst and an amateur becomes crystal clear.
When we face that scenario of warring time frames, we don't panic. We use this information to our advantage. What's the logic? When the 1-hour structure has broken and turned bearish, it means that all the demand zones belonging to the 1-hour time frame itself are no longer valid and are likely to fail. Therefore, placing orders on them is a high-risk action. This break on the 1-hour chart sends us a clear message. The market needs a deeper correction. Now the question is, where is the price likely headed? The answer is simple: to the nearest valid zone on the next highest time frame. This means our new primary target is that 4-hour demand zone we identified at the very beginning. We use the weakness on the 1-hour as a clue to anticipate the market's next destination and to wait for a much stronger trade setup at that major 4-hour level.
All right, let's return to our previous scenario. Our 4-hour time frame is bullish, but our 1-hour time frame has broken its structure and turned bearish. What is the first thing that happens after this downturn? Fresh new supply zones are created for us during this new bearish move on the 1-hour chart. So now we have a dual landscape. On one hand, the 4-hour demand zones are waiting for us far below, and on the other, new 1-hour supply zones have formed above our current price. This is precisely the point where we must act with extreme precision. And this brings me to a very important point I must make. You will not learn these things by watching this video just once. That's an illusion. You absolutely must spend hours backtesting on historical market data, observe the reactions, and train your eyes. After that, you need to practice for at least a few weeks on a demo or cent account before you risk your real capital. Please take this advice seriously.
Okay, let's continue. We're in that dual bias situation. What's the first possibility that could occur? It's that the bearish move on the 1-hour time frame was merely a correction and the price wants to return to the main bullish trend, which is aligned with the 4-hour. Do we immediately jump into a buy position at the first sign of a green candle? Absolutely not. We have a specific rule. If the price on the 1-hour time frame shows us a strong and clear trend change back to bullish, for example, a double change of character, only then are we permitted to think about buy positions again. Now, where should we enter? We look for an entry at the origin or the demand zone that caused that new bullish move on the 1-hour chart. The zone could be the first demand area formed or the extreme zone of that new move. So we patiently wait for proof of strength from the buyers on the 1-hour time frame.
But there is also a second possibility. What if that bearish trend on the 1-hour time frame is genuine and intends to continue its journey downwards? In that case, we simply go with it. As long as our 1-hour time frame maintains its bearish trend, we can continue to look for shorting opportunities at the supply zones that have been created for us on this time frame. See how clear our view is now? We are no longer confused. We know that despite the 4-hour time frame being bullish, as long as the 1-hour is bearish, we have permission to take sells in the direction of the 1-hour trend. This means we are surfing a deeper correction of the 4-hour time frame, and the ultimate target of this bearish move is to reach the 4-hour demand zones. This demonstrates a complete understanding of both directions of the market.
Let's summarize all of this into a few simple golden rules so they are always ingrained in our minds. Rule 1, if the 4-hour is bullish and the 1-hour is also bullish, our job is simple. We only look for long buy positions. Life is simple and beautiful. Rule 2, if the 4-hour is bullish, but the 1-hour turns bearish, we enter a two-sided market. We can look for short sell positions at the 1-hour supply zones. Rule 3, the most important rule. In that second scenario, when the price finally reaches our major 4-hour demand zones, we are absolutely forbidden from blindly entering a long position. We must wait in that zone for a new change of character on the 1-hour time frame, confirming that the 1-hour has turned bullish again. Only after getting this confirmation can we confidently enter a long position.
Now we want to make our analysis even more precise. We work with 3 time frames. We get our 4-hour confirmation from the 1-hour and our 1-hour confirmation from the 15-minute chart. Let's assume we are in that bearish 1 hour scenario. We zoom in on the last bearish leg of the 1 hour chart and enter the 15-minute time frame. Now, if our trend on this time frame is also bearish, what does that mean? It means our 1 hour and 15-minute time frames are perfectly aligned and in sync. This is the strongest possible condition for taking short positions. In this situation, we can with very high confidence enter sell positions at the supply zones that form on the 15-minute chart within the larger 1 hour zone. This is the pinnacle of using fractal analysis to find precise and safe entry points.
Let's place ourselves in the most critical moment imaginable. We've practiced for months. Our 1 hour structure is perfectly bearish, and the price is approaching a pristine, beautiful supply zone. Our 15-minute time frame has been completely bearish until now, and everything is set for a perfect sell. But just moments before the price reaches our zone, the 15-minute time frame suddenly changes its mind and forms a bullish structure. This is the point where the heart of an inexperienced trader sinks. But what do? We watch with calm detachment. Our rule states, at this moment, the sell trade is forbidden. We no longer trust that supply zone because our frontline soldier, the 15-minute, is sending conflicting signals. We must, with complete discipline, stand aside and wait for the 15-minute time frame to prove its weakness once again by creating a new bearish break of structure. Only then will we have permission to enter this battle. This is our ultimate filter to protect our capital.
This act of waiting is perhaps the most difficult part of trading. We live in a culture that glorifies speed and immediate action, but the market rewards those who can remain calm and motionless in the peak of excitement. There's a fantastic analogy for this. We must operate like a crocodile hunter. Have you ever watched a documentary on crocodiles? A crocodile is a master of the ambush. It can wait for hours, even days, completely still in the water, waiting for the perfect ideal prey to arrive. It doesn't waste its precious energy on every small creature that passes by. It waits for one opportunity, a thirsty deer, a large prey that is worth the risk and the energy. We must do exactly the same. We are hunters of A-plus trade setups. We watch the charts for hours, we analyze, and we wait for that one golden opportunity, that one setup that ticks all of our boxes to appear. This patience is a skill that builds wealth.
But during this wait, an inner monster called fear of missing out, or FOMO, awakens and whispers in our ear, "Hurry, the price is leaving, you're missing out on the profit." I am here to tell you to banish that thought forever. I have said it many times and will say it again. If a setup leaves without us, it does not matter. Do not be upset for even a second. The market is an endless ocean of opportunities. It will never run dry. Now let's silence that monster with logic and math. You do not need to catch every wave to be successful. You only need 2 or 3 good waves a week. Imagine you only risk 0.5% of your capital per trade. If you take just 2 successful trades with a simple 1-to-2 risk-to-reward ratio, you can easily achieve a weekly return of 3 to 4%. That is a phenomenal result that many large investment funds don't achieve in a year. So focus on quality, not quantity.
Here is a summary of our lesson on fractal sequence and confirmation. Our strategy uses the fractal harmony of the H4, H1, and M15 timeframes as a powerful filter for trades. The safest opportunities occur when all 3 timeframes are aligned. When a conflict arises, like the H1 moving against the H4, it is a warning that requires patience and discipline. Our golden rule: to enter with the main trend, we must wait for the lower timeframe to realign and provide confirmation. This requires the patience of a hunter, focusing on quality over quantity to overcome FOMO. Remember, no method is 100% foolproof. The responsibility to test this strategy and build your own conviction is yours. Thank you for watching this lesson. I hope you are always successful and profitable. Goodbye.